Okay, it's 12:10. Thank you everyone for joining us on this Friday afternoon where it's partially cloudy. I appreciate everyone being here. We're here with our team at Wilson Leung Associates and Asad from US Bank. Thank you for being here. Today is about refinancing, the basics, and things to think about when you're considering a refinance in the current environment. So why don't we do some quick intros? My name is Wilson. I started the team about 9 years ago, and we service basically the whole Bay Area with a focus here in the Peninsula. Jenny?
Hi, I'm Jenny Locke. I am on Wilson's team and help buyers and sellers in the local area. I also personally am investing. I own 22 units here locally and out of state. So definitely curious to learn about the refinancing process. Right now, I am going through a refinance with Asad right now, kind of cashing out and being able to leverage some of that cash that I've built from my property here to pay off other debts and see what my options are. So excited to learn with all of you guys too.
Thank you, Jenny. Ellie?
Hi, everyone. Thank you for joining. My name is Ellie. I've been on the team for 2 years, and I've been in real estate for about 8 years now. So I'm excited to learn with you and guide you through this process.
Thank you, Ellie. Hassan?
Welcome, everybody. My name is Hassan. Been on Wilson's team for almost 2 years now, and just like everyone else, help both buyers and sellers with their real estate needs and goals. I'll be fielding all your questions today in the chat box. So if anyone has any questions, feel free to insert them at any time. We'll make sure we'll have periodic breaks throughout the presentation to answer any questions you have. So don't be shy. Thank you.
Thank you, Hassan. Ashley?
Hi, everyone. Welcome. Excited to chat with all of you today. Thank you for joining us. I joined the team around the same time as Hassan, about 2 years ago, and just excited to help our clients that are joining us here today. And yeah, look forward to chatting with you guys more.
Thank you, Ashley. Wesley?
How's it going, everybody? I'm Wesley. I've been on Wilson's team since 2017, and I'm actually in a similar situation as some of you guys out there. I did a 7-1 ARM when I purchased my house in 2014, and actually I am due for a refinance. So there's going to be a lot of good nuggets in here today, and hope you guys enjoy the material.
Thank you, Wesley. If there's anyone else from the team, you can feel free to make an intro. And of course, Asad.
Thank you, Wilson, and everyone else for having me speak today. Thank you, everyone, for attending. I appreciate your time from your Friday afternoon. As Wilson mentioned, my name is Asad. I'm with US Bank. I work directly with them. I've been in the industry for over 15 years. Really enjoy what I do, and I help, and I love educating home buyers and people who own properties about what their options are with different mortgage solutions. So I look forward in going through the basics of the refinance and helping answer any questions anyone may have.
Great, thank you. So as Hassam has said, if you have any specific questions, please feel free to type your questions in the chat and we'll get to them accordingly. We'll likely have a Q&A at the end as well. If you have a question, and you can also unmute yourself if it's relevant to what's being discussed on screen. So going back to the presentation, it's all about refinancing, the basics in today's climate. So we're social as well. Feel free to follow us on Facebook, on Instagram, and on YouTube. You can tag us if you're watching this right now and you use those. First off, this is a slide we shared the other day when it came to the home buying webinar we hosted 2 days ago. So why real estate? Maybe Jenny, you can give us a brief overview as you did the other day.
Yeah, thanks so much, Wilson. So looking at right now with our economy and what's going on, there's a lot of uncertainty and a lot of people getting scared. I looked at my 401k from Oracle when I used to work there, and it plummeted 30%. So I was like, I'm glad I don't have most of my money in stocks and all of this, because there's a lot of volatility that's happening with stocks, and there's a lot of things that we can't control. And seeing that I do own multiple properties here locally in the Bay Area and in out of state, so Texas, Kansas City, and Alabama, I'm still getting rental income. So very happy to have made those investments. So just seeing the ability to be able to build equity. And what I also see, it's also I treat each property like a golden nest egg, where like it's a golden goose with a golden egg, where each month they're being able to produce income for me, versus stocks. If it plummets 30%, then now you can only work with that 70% left, and it's going to take a long time for it to bounce back, versus for real estate, we're able to get monthly income, and the property value might fluctuate a little bit, but overall, we still see renters wanting to rent and need a place to live, as it's one of the basic necessities with food, shelter, and water. So thanks so much, and excited to dive in. And then Asad will be able to share a little more about the different aspects of refinancing.
Perfect. Thank you, Jenny. And I believe we have a couple of slides that we're talking about interest rates currently. So this is in the last year. As you can see, we are trending, if not already, at the lowest point of where interest rates are. And of course, they've had some fluctuations within the last couple of weeks as well. And Asad can talk to us a little bit about that. And before Asad jumps in, I wanted to share with you a historic trend of interest rates as well. So since we've been tracking, this is courtesy of the Freddie Mac website. As you can see, there has been a trend of as high as, I believe, over 18% for interest rates for a 30-year fixed rate. And it's only trended lower as we've gone to today. So today we're going to be covering the refinancing basics, refinancing and process of obtaining a new mortgage in an effort to reduce monthly payments, take cash out from your home for other investments, changing mortgage companies if, let's say, you have some difficulties with your current one. Some people refinance for a consolidation of debt. If you're switching loan products, sort of like what Wesley had mentioned, if he purchased his house with an ARM and he's considering a fixed rate product, why would he consider that? We'll have Asad talk a little bit more. And of course, we probably will have some questions about leveraging a home equity line of credit or cashing out and refinancing, what the differences are and some pros and cons to each one. So maybe Asad, you can take over from here and discuss, the process and some of the things that we have prepared for the guests.
Sure. Thanks, Wilson. So the refinance process is similar as to what you may have gone through when you purchased a home. The lender will still need to verify certain information through your loan application and supporting documentation. Appraisal would still be required. So it's very similar to when you purchased a home. But what you do want to consider is what the benefit is for you when you're refinancing. There's a certain cost to benefit ratio that we would look at to see how much you could save on a monthly payment wise and what the cost potentially would be to refinance. There are no cost options available as well. So based on this bullet point right here, let me just go through what's written here. It says the process would be, if you have an existing loan, you would like to improve in some way. So what are the ways you can improve? One is to lower your interest rate. So rates have improved over the last several months. So there's an opportunity for you to lower the rate. You could also convert it to a fixed rate mortgage if you have an adjustable rate mortgage. Cash out refinance is another reason you'd want to refi. So those are some of the things you want to consider. And what you want to do is you could shop around with a few different lenders so you can compare what are the interest rates available for your specific scenario. Each client is unique and you would be getting different rates depending on your scenario. So you do want to compare with at least 2 to 3 different lenders see what their rates and fees are and what their terms are. And then once you find a lender that you trust and you're comfortable with what they're offering you, you go ahead and apply for the loan. And again, that's going to be similar to what you did when you purchased the home. It'll be a similar process, but the costs are going to be lower versus what your closing costs were when you bought the home. And finally, once the loan closes, you're going to make your payments to the new lender after that. Okay, so if we can transition to the next slide, please. All right, so the different types of refinance. So the first option on here is cash out home equity. So why would somebody want to do this? It's a variety of reasons. You could be interested in maybe investing in another property, remodeling your home. It could be any reason. So what you would do here is you access the equity through a new mortgage. So for example, let's say if you on your current mortgage, you owe $500,000 and your property is worth $900,000. You can access some of that equity through the refinance, get a larger mortgage to pay off your current lender, and then the cash out will be given to you at closing. And after the loan closes, you could do whatever you like with that cash out, whatever your intentions are. Another reason somebody would want to refinance is to change the loan duration. So as rates have come down, maybe you had a 30-year fixed and you don't want, you can pay off your mortgage sooner, whether it's 20 years or 15 years. So you could convert that to a shorter term fixed mortgage. And that'll help you save a significant amount of interest over the life of the loan. So in terms of fixed mortgages, the ones that are most common are 15-year fixed, 20-year fixed, and 30-year fixed. The shorter the duration, the lower the interest rate will be. And then, of course, you'll be paying off the home depending on what duration you go for. So 15 years, the home will be paid off in 15 years. So another reason that you'd want to refinance is, of course, to lower your rates. Rates have been a little fluctuating over the last couple of weeks, but they're still at an all-time low. So depending on your scenario, you could reduce your interest rate. Typically, it would make sense if your rates come down by at least 1/4 to 3/8% at no cost to you. So there are options out there for a no-cost refinance where there's a credit tied to your interest rate. So if you're getting something with no cost and your rate is coming down by at least 1/4 to 3/8%, then the refinance does make sense for you. Another reason is changing your loan structure. So you could have a adjustable rate mortgage where the rate is going to adjust at the end of the fixed period. So for example, 7-year ARM, and if you got that in 2014, your rate is going to adjust 2021. So you want to try to refinance maybe into another ARM with a new fixed period or into a 15, 20, or 30-year fixed mortgage. And the last one on here is a good one as well. If some borrowers purchase a property with less than 20% down, they would have mortgage insurance. So if your property has appreciated, you can refinance and your mortgage insurance will be eliminated. Some loans right now that are not FHA, you can actually eliminate the mortgage insurance without refinancing. Those are the standard agency loans, or basically the non-FHA loans. You just talk to the mortgage servicing company, they do an appraisal, and if they determine that you have at least 20% equity, they'll eliminate your mortgage insurance. But if you have an FHA loan, the mortgage insurance stays with the loan until you refinance out of it. Okay, so one other program that's available out there is reverse mortgages as well. It's not on this slide, but reverse mortgages is more directed towards seniors. Our bank doesn't offer it, but I would be happy to connect you with lenders that do. And that's where you can derive an income out of the equity of your house. Instead of doing a cash out refinance, you apply for reverse mortgage, and the lender that you work with, once it's closed and approved, they'll actually be sending you monthly checks as an income source out of your equity of your home. All right.
Yeah, Asad, we do see a question that just came in as well from Randall. I'm not sure if you see that.
Yeah, let me open up. Yeah, let me read through it. So it says, I refinanced last year, but with current rates, I'm looking to refinance again. Is there any length of time that I'm not allowed to refinance? Is there any downside to refinancing as often as twice in a span of 2 years? So that's a good question. Most lenders these days don't have any prepayment penalties or early termination fees. So that's something that you could check with your current lender if you want to be safe and ensure that there's none of those penalties, but it shouldn't be around these days. So that should answer the first part of your question. And then the second part, in terms of if it makes sense, as long as there's a benefit for you, then it does make sense to refinance. There shouldn't be any restrictions. So that's something that the mortgage banker you're working with, whether it's me or somebody else, should do an analysis for you and see what the benefit is. You shouldn't refinance just to refinance because that's going to reset your mortgage payments. Your mortgage is set on an amortization schedule. Initially, when you get your mortgage, more money is going towards the interest. And every month as your mortgage gets older, additional money will be going towards your principal. So when you refinance, it resets or recasts that. So if you have a good mortgage banker you're working with, they'll analyze all aspects of the refinance versus what you have right now and make sure that there's a benefit for you. All right, thank you. So if we can go to the next slide, please. All right, so closing costs. Closing costs, as I mentioned earlier, is going to be a lot lower than when you purchase a home. The main closing costs are going to be from 3 third parties involved in your loan process. So that's going to include the lender, whatever their fees are, the appraisal, and then escrow and title company fees. So the first bullet point here is essentially referencing the lender fees, the application fee. Typically, from my experience, most of the top 5 banks around here, their fees are going to be anywhere from $1,000 to $1,100 in that range. So that would cover your lender fees. The next category is your escrow and title company fees. So you may recall that you went through an escrow title company when you purchased the home. They are the intermediary between the buyer, the seller, and the lender. They offer title insurance. So when you refinance, the title insurance for the new lender is going to be required as well. And then all of the relevant escrow fees. Depending on your loan size, the rough estimate on what the title and escrow fees are will be approximately $1,500. And so that also is going to cover your notary fee and any settlement fees. So that'll take care of the next 2 bullet points as well. The 5th or the 6th bullet point is your appraisal fee, and that's approximately $500 for appraisal. The property does have to get inspected by an appraiser to determine what the current market value is, and the fee for that again is about $500. So you're looking at approximately $3,000 to $4,000 in total closing costs, depending on how big your loan amount is. And there are options to do no-cost refinance as well. The way that works is that you do get a lender credit that's tied to your interest rate, and the lender credit would cover your costs, so you don't have to come in with anything out of pocket. The last bullet point is points and fees incurred in loan origination. So what that is you have an option to buy your rate down as well. So the rate is kind of like a tiered, if you can think about that. For example, let's say at 3.5%, you're getting X amount of lender credit. And if you're interested in getting a lower rate than that, you would pay a buy down cost. So if you want to go to the next tier, which is 3.375, you would pay a buy down cost to get to that level. And the fee on that varies depending on where the rates are at that day and what your scenario is. Okay. Any questions on this slide? So I see one question over here. What situation do you see people buying down versus not? So the situation it would make sense for you to buy down is if you feel it's going to be a long-term mortgage that you're going to hold on to. You want to see how long it's going to take for you to recoup that upfront cost that you're paying. Typically, it could take anywhere from 4 to 6 years, depending on how much that cost is. So that's what you want to look at, is to see how long it takes for you to recoup that and ensure that you'll be staying in that property at a minimum of that amount so you can at least incur that benefit. Okay, I see another question on here. How will binders affect closing costs? Sorry, if you can clarify what you mean by binders. Buy down?
Yusuko, you can come off mute if you like.
I'll answer the next question while we get that last one clarified. It says, for no cost refinance, is there a credit score requirement? No, there's no credit score requirement for that. Again, it's tied to the rate, and each rate could deliver a certain credit or a buy down cost. So that's how that one works. And then there's
one from Jeff too as well, Asad.
I'm sorry, what was that?
There's one from Jeff as well. When is someone eligible for lender credits versus when they are not?
So anyone is eligible for the lender credit. It's tied to the interest rate. So depending on what rate that you want to go for, you can get a lender credit. The higher the rate, the larger credit you can get. But typically what I try to do is give a rate quote that's closest to par pricing, which means that where you don't have to actually buy your rate down, and that's at that particular rate will give you some credit to cover your closing costs.
And I think Asad, Yusuko's question was in regards to buy down, referencing does buy downs affect closing costs?
Got it. Okay. Yeah. So it'll be added as part of your closing costs. The buy down does affect it. And then in terms of your closing costs, if you don't have lender credit, or if you're not getting lender credit to cover it, your options are that you can include it as part of the new loan amount. So you don't have to come in with any out-of-pocket costs, or you can come in with the cost yourself out of your personal savings. So that way you don't have to build it into the loan. Okay. So is this the next slide, I believe? So this slide is discussing an alternate option to doing a cash out refinance, which is the HELOC, home equity line of credit. So if somebody's interested in doing a cash out or a HELOC, there's certain pros and cons on each one. My personal opinion, and from my experience, the HELOC is good for more of a short-term usage because the interest rate is tied to a variable index, tied to the prime index, which as of today is at 3.25%. So if interest rates do start moving up, your HELOC interest rate will also move up. But at the same time, if rates stay the same or if rates go down, then your rate won't change. So the HELOC is, again, it's variable, and it's good for a short-term solution. I would say at least for if you plan on paying off the balance over the next 1 to 2 years, then a HELOC could be a good solution versus doing a cash-out refinance. And the way HELOC works is similar to a credit card. You get approved for a high credit limit. So let's say, for example, you apply for a HELOC and your file goes through underwriting, your full loan application, and you're approved for $100,000. So you'll have a zero balance. So you're not going to have a monthly payment until you actually use your home equity line of credit. And your max on it, on this example, would be $100,000. Whenever you do use it, it'll be an interest-only payment that you are required to pay. So the minimum payment that you make is just interest only, and you can make additional principal payments anytime you'd like. So the HELOC, again, is a second mortgage. It'll go behind your first, and it's also borrowed against the equity of your home. Okay, so if we can transition to the next slide, please. All right, so before I go to the next slide, I think there's a question on max on HELOCs. So I think somebody's curious on what is the maximum you can qualify for a home equity line of credit. It really depends on your scenario, primarily on your loan to value. That essentially means your combined loan amount first and how much you want to apply for the second, divided by the value. But I've seen home equity lines of credit as high as 500,000, even higher than that. So it depends on your unique circumstance. All right, so moving on to the next slide. This is break-even point. I touched on this a little bit earlier. Break-even point is essentially outlining how much you pay for your closing costs and how long it's going to take you to recoup. If you're doing a no-cost loan, there's not going to be a break-even point because the lender credit is going to cover it. So this is only for scenarios where borrowers have to pay closing costs or if they're buying their rate down. So in this particular example, it says that the closing costs based on 2017, it showed the average was about $4,876. And what you want to do is calculate what the savings are for you to refinance the mortgage divided by the cost, and then it'll tell you how many months it's going to take to break even. And if you plan on keeping the mortgage more than that, then you know it's going to make sense for you to refinance. And that's essentially your break-even point right there. Majority of the loans that we're doing though right now are at no cost or minimal cost. The break-even point again only comes into play if you're looking to buy your rate down and pay points. Okay, so federal rate versus mortgage rate. I'm sure everybody's been inundated with news articles and the media about the Fed cutting the Fed funds rate. So that doesn't have a direct impact on mortgage rates in the short term. The Fed fund rate does have an impact on a home equity line of credit directly because it cuts the prime index. So when the Fed cut the rate to 0 a couple of weeks back, the prime index also rolled down. And as I mentioned earlier, that's at 3.25%. So if anybody has a HELOC right now, they probably noticed that their interest rate was cut. So that's good news for you guys. But in terms of mortgage rates, the Fed fund rate doesn't impact that directly. But from my experience, I do see a trickle down effect over the months. Maybe in the next 3 to 6 months, we could see the mortgage rates potentially come a little bit lower. But as of right now, the Fed's cutting the rate hasn't impacted the mortgage rates. So the things that actually do impact the mortgage rates, based on my 15 plus years being in the industry, there are a couple of indicators that you can monitor that'll tell you short-term wise what mortgage rates are going to do. And you can look these up on the internet. If you just type it on Google, they'll pop up. The first one is going to be the 10-year Treasury note. So the 10-year Treasury note is a bond that trades in the secondary market, and the trend that has with mortgage rates is direct. So if you see, or sorry, indirect. So if you see the 10-year Treasury note going up, it's an indication that the rates are going to also go up. And if the 10-year Treasury note is going down, then it's indication that rates will also come down. So that's a good short-term indicator to follow. And then the next indicator is mortgage-backed securities. That's also a bond that trades in the secondary market. When lenders close their loans, they typically bundle them up in the thousands and sell them in the secondary market to investors. So the mortgage-backed security is something else that you can look up online, and that has a relation to what mortgage rates are doing as well. So if we can go on to the next slide, please. How are banks operating during the shelter in place? So with most banks, it is business as usual. I can speak for US Bank. They've transitioned a lot of their operations employees, which includes the underwriters, processors, the closers, and funders, to working out of their home in order to be more safe because of the COVID-19. But it hasn't impacted our turn times on purchases or refinance. So we are operating business as usual. It hasn't impacted our liquidity or anything like that. How are appraisers operating during the shelter in place? Appraisal process is happening as normal as well, but there has been talks of potentially doing drive-by appraisals in the future if the COVID-19 does increase in our community. So there has been talk that appraisers may be able to do drive-bys instead of actually going inside of the properties. Nothing has solidified on that yet, but if it does, I'll definitely communicate it to the team. Okay, what is the mortgage payment moratorium or the forbearance? This is something that's been recently talked about in the news because, again, of the COVID-19 and some layoffs that have been happening for people around the world, around the US. And there has been many lenders right now that have communicated to the media and to their clients that they're willing to do a forbearance on the mortgage payments. And essentially what that means is that they're delaying the mortgage payments without having to charge any late fees, and also without having to report them as a late payment on your credit. So every lender is different. So if you do have a current mortgage and you want more details about it, definitely reach out to the customer service or the mortgage servicing company that holds your mortgage to get more details around that. With US Bank, we have implemented a 90-day forbearance. And if anything further is needed beyond that, they are willing to talk to customers directly to see if potential loan modifications would help them as well. All right. Was that the last slide? Yes. So a couple of other things I wanted to share with you guys is what specific factors are considered when you request a rate quote. So essentially, what impacts the interest rate for your specific scenario. So the things that are going to impact it are your loan to value ratio. Again, that's the amount that you owe versus the value of your property. Your credit score, of course. Your loan amount also impacts it because there are a variety of different products available, and each product has a different interest rate depending on the loan amount. The property type, whether your property is a condominium, a duplex, a 4-unit, a single family. So those comes into play when we determine what your interest rate is. Occupancy of the property, whether it's a primary residence, second home, or an investment property. The transaction type, if it's a purchase, rate and term, or a cash out refinance. So they'll have different interest rates depending on the transaction type. And also if there's a second lien behind your first. So if you have a home equity line of credit. All right, I think there might be a couple of questions.
Yeah, hey Asad, I have a question regarding rental property. So let's say you do or you don't have rental history and it's showing up on your tax returns for the last 2 years. As people take advantage of opportunity in this type of market and are purchasing investment properties, can we use the projected rent of the target property, and how would rental income for current properties factor into a purchase?
Sure. So if you do have a 2-year rental history on your tax returns, then definitely we can use projected rental income on a new investment property that you're looking to purchase. Typically, we would just do a rent survey on the new property to see what the current market rent is in that area. And then there's a 25% vacancy factor that's applied to that number, just to take into account potential issues or expenses with the property. So essentially, we would be able to use 75% of the market rent survey. And then if a borrower does not have a 2-year rental history, we would not be able to use the rental income for their scenario. But if they own a primary residence and they're going to be moving out of their primary and converting that into a rental property, we could consider that as a departing residence. Use rental income for that. Does that help answer the question? Yeah?
Yes, it does.
All right, great. So one other thing also is that there are different types of mortgages available. And I just wanted to touch on that real quick. So you have your agency loans, and agency are loans that are sold in the secondary market to a different investor once the loan closes. You may have heard terms of Fannie Mae and Freddie Mac. So those are the typical investors that will purchase these and they'll service them. They have minimum and maximum loan amounts. So the conforming loan amount in the Bay Area for agency loans is $510,400. And for jumbo conforming is anything over $510,400 to $765,000. And right now, jumbo conforming is kind of the sweet spot where rates are the lowest. So again, that's between 510,000 to 765,000. That right now is pricing out the lowest between any of the products. And then if your loan amount is over 765,000, it would be considered true jumbo, and that would be done on our portfolio products. And then besides that, of course, you have your government loans, so FHA or VA loans.
Asad, we have a couple questions that came in during that explanation. Thanks for breaking that down. One is from Brad, which is in the chat box. I don't want to reread it if you want to take a look. And then one's from Rachel and Wilson as well. Do you see those?
Yeah, let's see. I see Wilson's, and let me scroll, see if I can. You said it was from Brad?
Yeah, actually, yeah. Brad is on using his wife's Zoom, so I made a mistake earlier. Apologies, but Yasuko is Brad.
Okay. Is there any way we can find the current mortgage rates, or do we have to request a quote from a specific lender? So lenders do advertise their mortgage rates online, but typically online is not going to be the true rate that you could get if you call a mortgage consultant directly. So it would be better if you reach out to a mortgage banker directly to go through your specific scenario. I'm very direct, so if you do reach out to me, I wouldn't make it complicated for you. We wouldn't need to run your credit. I could tell you what your interest rate would be for your specific scenario. And I do actually have some interest rates that I wrote down based on some standard scenarios. So as of today, the 30-year fixed on a refinance rate and term is between 3.375 to 3.5% on a 30-year fixed. And then on a 7-year ARM, it's at 3%.
And Asad, actually, I'll go ahead and read Brad's question. It was before that. He
Okay.
mentioned with my investment on a single family property that he is refinancing out of a hard money loan. How long should I let the new loan season before I attempt to cash out on my primary?
Okay. So if it's a refinance, you don't need to let it season. The only time you do need to let it season if it was a purchase. If you had purchased the property, typically the seasoning requirement for that before you do a cash out refinance is 6 months. But if your last transaction was a refinance, I'm not sure if I caught that properly, then there's no seasoning requirement.
Thank you, Asad. We have one from Wilson. Can an individual leverage for a future purchase cash out, refi HELOC, plus qualifying for a purchase mortgage together?
Let's see. I see the question on here. Let me just read it. So can an individual leverage for a future purchase, cash out, refi, HELOC, plus qualifying for purchase mortgage together? That's a good question. So if you're looking to purchase for the future purchase, if that's going to be for an investment property, then yes. But if it's for another primary residence and you're trying to do it at the same time with the same lender, then that answer to that will be no, because you can only do one owner-occupied transaction on one property every 12 months. So if you did a cash out refinance on your owner-occupied home and then you're trying to do another purchase mortgage on your owner-occupied home with the same lender, that wouldn't work. Not sure if that helped answer your question.
There's one more that we see here from John. By the way, everyone, Jenny included a link in the chat if everyone wants to take a look at the rough ideas of what rates are. There's a link she included in there that you guys can take a look at. The only other question I see in here, Asad, is from John, mentioning besides HELOC, if you had equity in real estate, what are different ways of investing the equity on another real estate or property?
Other ways of accessing the equity besides the HELOC? So the only other way would be to do the cash out refinance. So paying off your existing mortgage and then taking out a larger first mortgage and taking the difference as cash out directly to you.
Thank you. That's all I see from now. If anyone has any other questions, please feel free to chime in.
In terms of
I have a question.
Yeah, go ahead.
How's everyone doing?
In Doing good.
Sorry, go ahead, Asad.
I was just going to say, for timing wise, how long does it take for us to close a refinance? If we work together and put together a very clean package, we're looking to close probably in about 30 to 40 days. So that would be the timing from the period we submit your application until closing.
Are you still getting a big influx of refinances at this time?
It slowed down a bit, but we are still getting applications, particularly on adjustable rate mortgages. On the agency loans, those rates went up tremendously over the last few weeks. Their 30-year fix is still competitive. With our products, specifically on the portfolio side, our ARMs are still good. I think there's another question on there.
Yeah,
So
David asks, are there any good calculators or resources that are available to calculate monetary trade-offs of doing a refinance?
Not aware of any, but I think that breakdown or the break-even point analysis that we had on the previous slide is probably the best way that we can do a calculation. Just compare what you're paying right now versus what the savings is going to be, and also what the potential cost is, if any, and then that'll tell you what the break-even point is, if any. If you're doing a no-cost refinance, then definitely, I mean, there's a benefit if your interest rate is getting lowered. I also have an Excel amortization table that I'd be happy to share with everyone. I can send it to Elizabeth, and maybe she can distribute it to all the guests here. You could plug in your current loan scenario on there, and it'll tell you how much of your money is going towards your principal versus your interest rate. That way you can compare it to what it would be if you were to refinance.
And I would like to add into that as well to answer David's question. So other things that you want to look at is what are you going to do with the refinance money, and what are you going, like for example, I'm doing a cash out refinance on my house and going to pull out about $350,000. So what am I going to do? Like as Asad mentioned, we can invest in other investment properties that are cash flowing. So I'm rolling that into other cash flowing properties. So that's one perspective, and looking at the return of that, I'm getting 10% plus return on that. So it does make sense to calculate on that perspective, not just really looking at the monetary monthly, although my monthly is going to go up to do the cash out, but I'm getting higher returns elsewhere since interest rates are so low right now.
So another thing that some of you can do if you want to shorten the amortization on your mortgage, Wilson brought it up on the comments here, is bi-monthly payments versus monthly mortgage payments. So if you split up your mortgage bi-monthly, it's going to save you a lot of interest over the life of the loan, and it'll also shorten the amortization or the period that it'll take for you to pay off your mortgage. In addition to that, you can always make extra payments. There's a general rule, for example, if you make 13 mortgage payments in a year versus 12, you'll be able to pay off your mortgage probably about 4 to 5 years faster.
Great, thank you, Asad.
Yeah, you're welcome.
I had a question come in from John. If you had a real estate in LLC, is the process the same to refinance? I think Jenny, you have an LLC, right? Or I'm not sure.
So yeah, it depends if just the title or the vesting is under an LLC, then the process is still the same. It's just the way you hold title. So we would be able to close it for you under the LLC, but you would still qualify with your own personal income, personal credit, and assets.
Just to point out, Wesley threw in the comments that if anyone would like the current rates and info on refinancing from Asad, you guys can enter your emails in the chat box. Thank you, David, for putting yours in. Anyone else that would want to put their email address into the chat box, we'll compile those from our marketing team and coordinate that you guys get the information that you guys need. So feel free to put that in now.
Yeah, thank you again for taking the time to join the call today. I know it was a lot of information, a lot of new acronyms and words that you may have not heard before. So definitely feel free to reach out if you needed clarification on anything. I'm happy to help.
Yeah, and part of that email too, what we'll do is we recorded this. So what we'll do is we'll create a video out of it that I'll have a direct link to the recording session, and you guys can be able to share this recording with others that might have a similar interest. So that'll also be part of that. Thanks for all the emails coming in.
Thank you everyone for being here. Thank you, Asad. Thank you, team. And reach out with any questions.
We also have a estate planning class that's a trust and estate planning class coming up next week that we will forward to you guys. I believe it's going to be on the 1st. So we'll share that information via, and if there's any interest, you guys can reach out for that. Thank you everyone for the emails. Any last minute questions? We have about 4 minutes still on this call that Asad can assist, so feel free to chime in. Oh, Asad, we have one question from Ricardo. Do you anticipate mortgage rates to go down later this year with the frequency of applications likely to slow down?
It's possible, but just the market right now is so uncertain because of COVID-19. And it's really hard to tell if rates will go down. If you are getting a scenario where you can refinance to lower your rates with no cost, and you're having a significant savings, it definitely does make sense to just go ahead and take that opportunity now versus risking waiting later in the year, especially if there are no prepayment penalties and no restrictions for you to refinance down the line. If the rates do come down, you always have that option.
And one more here from John. Thanks, Asad. Is there a difference between mortgage brokers for a big bank and independent?
The difference is that with big banks, we have pretty much one set of guidelines that we work with. We're direct lenders, whereas with a mortgage broker, they're approved with, or they are either approved or they work with various wholesale lenders or correspondent lenders, anywhere maybe from 5, 10 to 20 different lenders. And they could compare your scenario with each different lender to see if they can find a guideline that best matches your scenario and try to get you the best interest rate with those other lenders. Mortgage brokers do have a middleman who's the mortgage broker themselves, because they don't close the loan with their own funds. They have to get it with a wholesale lender or correspondent lender. So depending on the scenario, at times their rates may be a little bit higher versus what direct banks have to offer.
Thanks, Asad. I don't see any other questions at this time.
Yeah, I guess for other questions, definitely reach out to us just to be respectful of time. It's almost 1 p.m. So thank you everyone for being here. Thank you, Asad. Thank you everyone on the team. Thank you all our guests. Happy Friday.
Thank you, everyone. Have a good day.
Appreciate
Thank you.
Have a good weekend.